Hello, Oracles. Sorry for the delay there. I was on the phone with my son, and no offense to you guys, but he takes priority over all of you. So just having a chat with him. We were playing some games. Oh man, taking a look at the market here. Let me know what you guys if you guys have issues. My microphone has been kind of humming lately because this room has an echo and it's worse than before, but hopefully it's not too bad for you guys. So market starting to cool off a little bit, which we kind of expected. I talked about it on the video the other night, just discussing the gaps for Tesla and how a lot of this was emotionally overblown. Um, and now we've drawn ourselves down below that support level at the 314 to 316 level, closing at 311 today. So the question is going to be, do we push back up above it tomorrow, or do we continue to fall back down? So we will discuss a little bit of that today. And again, I have no idea. Nobody knows for sure which way it's going to go. When you're looking at near-term stuff, you can follow charts to see which way you're going to go. Long-term, it doesn't really matter. I think 5 years down the road, Tesla is going to be more valuable than it is today. So if you're going to be holding it for 5 years or more, it really doesn't matter, unless you're looking to buy at a lower price. But none of that's guaranteed. Um, So that's up to you guys, and what you have to do is your own investing decision. Sorry, I'm trying to get that straightened out. So you guys got to do what's best for you. But for me, my portfolio, I'm doing some consolidation and expansion kind of at the same time. I'm consolidating in some areas, but I'm adding some more of the ultra yield ETFs back to my portfolio on a short-term basis. So I've decided that I'm going to leave it at 5% of my portfolio, and right now it's about 2.5%. So I'm going to be doubling my allocation over the next couple of months to that, to increase the monthly income I have coming in, to speed up this process of me getting myself to the dividends income that I want to have coming in. So I will be showing you guys that. You'll see that reflected in my monthly videos where I show you my portfolio, and you'll be able to see all of that. So I'm looking forward to that. Actually, I'll jump on here and I'll show you guys which ones I'm going to be adding, so you can see. And cryptocurrency cooling off as well. And now this is just tips that I've been hearing from people in the crypto community. I would not consider myself in the crypto community. There's a lot of people who are deeper in than myself. I'm more of a fringe investor when it comes to crypto. I have four. I've got Bitcoin, Ethereum, Dogecoin, and SHIB. That's it. SHIB is strictly because typically those coins, when you do get a massive run up, they tend to give you a higher percent return. And it's just going to be trailing behind Dogecoin. And it hasn't been pushing up like Doge has. But from those people in the crypto community, I have been hearing, based upon, and I've seen it before as well, how crypto typically trades. You'll see, obviously, this massive push up right now. Bitcoin goes, Ethereum goes, Doge pushes up, and then you see a bit of a correction. And then that's when you want to buy all the altcoins, and it's going to make a second push up. Whether that's actually going to happen or not, I don't know. Historically, that is what has happened. So we will see what's actually going to transpire this time. So we're seeing a bit of a cooling off. We've kind of hit a wall around that $90,000 to $92,000 mark when it comes to Bitcoin. Doge kind of hit that 40 cent to 44 cent mark and kind of stalled, and has been kind of selling off from there. So seems like we've hit kind of a resistance level in a lot of areas when it comes to crypto. So we'll see what happens from here. I know for me, I've been trimming a little bit off of my Dogecoin. That was my heaviest position when it came to dollar amounts. And Dogecoin's been running the most. So I've been trimming a little bit off. And the way I do it is just like, as I hit a certain level, I just take $50. I don't do it by coin or anything like that. I'll take $50, because $50 as it's pushing up is less coins. So I'm just taking $50 and $50, and I'm not selling off as many coins. So if we do end up pulling back and it falls below my threshold, I'll just add more. It's my kind of way of cycling and recycling because it moves as much as it does. But let me get, I'll have to check here because my entire computer crashed this morning apparently, and I had to reboot it all when I got in today. So it's just I just want to make sure everything is up and running properly. Oh yeah, we look like we're good. Okay, cool. All right. What's going on, Lang? Good evening. With high tariffs and Doge laying off government employees or closing off agencies, what are the side effects? Recession, trade wars, recession. And I was talking about that the other day as well. Is it's one of those necessary evils, and recessions, they obviously suck when you go through them. There's nothing um, easy about a recession, but it's like spring cleaning. It's almost like it's a necessary evil, I would say, because it cleans out a lot of zombie companies that are weighing down the economy. It does a good job of kind of flushing out a lot of unnecessary jobs in the government if that's the route they're going to go in. In this case, it certainly sounds like it's going to be. And a lot of those jobs that are in the government are redundancies. And I was making a relation about it the other day. A lot of the jobs that are made in the government, and most of the government jobs, when it comes to non-military stuff, are usually from the left, and they're created, and it's almost like an artificial inflation of employment. So it looks like unemployment is low, but it's just because they gave a lot of people jobs within the government that aren't actually bringing in GDP for the government, and it's not bringing in those revenues and those tax dollars because that's where like you get the tax dollars from the corporations who are growing private companies or companies that are publicly traded. That's where you're getting the revenues coming in that go into taxes into the government. You have government agencies that aren't paying taxes. So they're more of a cost than a revenue. And so when you've got those jobs that are out there and you just create a whole bunch of jobs just to, make it look like your unemployment is good, or you're just trying to give people jobs, which is great. You're giving people employment so people have money to spend, but it's some of the jobs are sort of like if you have your child move a box from one side of the room to the other just so that you can pay them an allowance. Is that really a job that needs to get done? No, it's not a productive job whatsoever. You're just having them do something. They're learning to have a job and you're giving them money for it. And unfortunately, there's a lot of government jobs that are out there like that. So when you have somebody who, like Elon, who we know will wipe out way more people than he probably should when it comes to business, we will see how that goes when it comes to the government, because if that's the case, we could see a big flush. And yes, that would absolutely lead to significantly higher unemployment and a recession for sure. Now, when it comes to the long-term health of the economy and the government, it's a good thing. It is. It's just going to suck in the near term, and it's going to suck real hard. So that's going to be one of the challenges that we have to face probably in the next year. And again, I think he was given 21 months. So I think they have until July of 2026 to make it happen. Sounds like Elon's saying that he's going to have it done well before then. Obviously, he's been thinking about this for a while. And by the time Trump ends up going in and taking over, they're going to have plans already rolling out. They're already talking about removing the EV tax credit. So a lot of things that are coming to thin out the government, which taking away the social aspect of all of this, strictly speaking, financially, running the government like a business like this is important. And at least like, so when you run a company, you're running your business when times are good, you'll do the spending, just like the last 10 years we saw in the market since the financial crisis. You saw a lot of spending. That's a lot of growth. You want to spend and grow. And then when you have times that are kind of getting slowed down, that's where you thin things out. You do your layoffs. You kind of, consolidate the company and run a little bit leaner. And you're like, all right, so, we can trim the fat, get rid of the fluff, see how much we can cut to still continue growing our company at a much leaner rate. And those are necessary. It's just, again, that spring cleaning and flushing. And the government hasn't really gone through that. It's usually every 10 years we get something like that, like a recession. And it's about every 10 years we go through that flush and we go. And while you could say that we got the recession during COVID, it wasn't a same type of recession like we saw for the great financial crisis. So I hate to say we're due for one, but we could really use one. And that's, I think, what we're going to get. And we're probably going to get an extreme version of it based upon the people who are advising for it. Let's see here. All right, let me bring up my yeah, and as my dad says, markets thrive on certainty. Not going to have much of that going forward. Be careful. Exactly. The one thing the markets hate the most is uncertainty. which is why you'll see lower volumes. And when you see lower volumes, that's higher volatility in the market. So with that said, not knowing what's going to be happening with Trump and who he's putting in all of these places, some people are going to think it's good, some people are going to think it's bad, and that in itself is going to cause the market itself to be uncertain, because the market itself doesn't really take sides. It just wants to know clarity. It wants clarity as to what is going to happen. Whether it's going to be good or bad, it doesn't matter. If the market has clarity, it's happy. But we're not going to have that clarity because we truly don't know what's going to happen. Now, Elon does say that he's trying, I guess they're going to be putting out there, I don't know if it was like an open AI, open government, whatever it's going to be, with just, hey, this is what we're doing, as much clarity as possible. So maybe that will help. I truly don't know. But any uncertainty that we're going to have over the next year or two is definitely going to be a tough time in the market, which is, again, just another signal and red flag for me, pointing to that recession and pointing to the way I've been running my portfolio, as I'm preparing for the worst and hoping for the best. I hope we don't get to that point, but I just want to be prepared and I want to be ready for it, because truly don't know. I mean, we could get into some really ugly things, and it could get dicey pretty fast. And then of course people losing jobs, that's never going to be good. And then of course people losing jobs, that means less money from any of those people who are putting it into the market. They might have to sell their stocks, which is going to bring down the market even more, just so they could pay their bills. And Elon did say, brace yourselves for tough economic times. So he's giving us as much clarity as possible. And if he's saying that, I'm gonna brace for it. More sell-offs coming? Yeah, more selling offs coming for sure. And again, when I went through the gaps the other day, I got enough comments, the same as I had gotten before, people thinking, oh, we're never going to go under 300, never going to go under 200. I was one of those people. I thought when we were at that all-time high at 414, even before the split, I never thought we were going to drop below $1,000 again. Sure enough, post-split, before the split, we got crushed, and we haven't been back above that since. So I guess technically we just tapped over it briefly this week, but other than that, we haven't gotten back there. So it's been 2.5 years, and everything that everybody said was never going to happen actually happened. So this time around could absolutely happen again. If Tesla splits at some time, would TSLL do the same? No, it's two different funds, so it's independent from one another, totally separate. So TSLL, if it's running up and doing extremely well, maybe it does do a split. But with an ETF or a fund like that, it's totally different. Just like TSLY did a reverse split because of all of the NAV erosion on it, and Tesla did not do a reverse split. So completely separate entities on that. Thanks for doing the live stream. Oh, thank you. I appreciate that. Thanks for watching. So Thursdays, seems like Thursdays should be a good time, because Fridays I'm now going to be going to see my brother and nephews. So that will be my Friday evenings from now on. So family time first. So I'll be doing the live streams on Thursday. My dad have been moving from equities to fixed income for the last 6 months. Expect higher rates. Yeah, I think the rates, we're still going to see rate cuts, of course, coming. And of course, if we're going to get into a recession, Trump may push Powell to go to 0% again, which I don't know. If that's what happens, that's what happens. But I think Powell right now is trying to get to the point where they're going to be between 2 to 2.5% interest rates as a normal standard. That's where ideally that's where they want to be. So if we can get there and hold there, that's great. But you never know if that's actually what's going to be transpiring. And again, Trump has already said that he wants to get rid of Powell. Powell said he doesn't want to get out. Powell technically has his term through, I believe, May of 2026. So May of 2026 is for Powell. July of 2026 is for when we have the government, the whole Department of Government Efficiency. That's their deadline. So we'll see if Powell rides through this, or we'll see if there's a replacement coming. Sounds like legally Trump can't just remove him unless there's something major that happens, and perhaps he can finagle it if we do get into a recession and say it was Powell's fault. Again, all of that is total speculation as to what can transpire. And again, that's the kind of stuff that's going to be leading to uncertainty in the market and causing the market to, sell off, as you would say, because just as we had seen, basically we saw a lot of it over the last couple of years. When the market doesn't know what's going on, we didn't know what was going on with rates getting hiked up. We didn't know what pace the Fed was going to be going at. We just didn't know. So there's a lot of big money that takes a lot of their money out and just puts it on the sidelines and waits. And it's like, you know what? We'll hold it over here. And especially with higher rates, it was a lot safer. You can now get, at that time, it was like 5.5 to 6% on treasuries. They're like, well, of course. Why would I not put my money there? I can get a safe 5.5 to 6% yield versus an unknown what's going on in the market right now, collapsing 40% in some cases. So, yeah. Now, granted, if we go forward and the rates are coming down, they don't have that same luxury. But some of the longer term yields that are out there can still do that. You can get, 5 and 10 years for a little bit higher. And then, you can go into, there's the higher dividend plays, which is why I think higher, consistent dividend plays that are the staples and the places where people put their money in recessions to mitigate some downside risk. The Procters and Gamble's, Coca-Cola's, Pepsi's, consumer staples, and a lot of places like that. That's where a lot of money will end up going as well as the rates come down, because they may only get a 3 to 4% yield, where they might be able to get, a 4 to 5% with some of those stocks, especially if we're seeing the entire stock market pulling down. Those stock prices come down, those yields go up on the dividends, and as long as the companies are still showing, good free cash flow, which you go back to the great financial crisis. And back then you still saw companies increasing their dividends, despite the fact that we were going through the big recession. That means that you were getting a lot more income for a lot cheaper. That's, buying a lot of, it's like, bargain, fire sale prices. So that's why people are doing that. Let me jump into my portfolio here real quick. I'll show you guys where I'm at and what I'm going to be adding. And again, and I'll explain to you what I'm doing and my thoughts behind it. So make sure this doesn't get all screwed up. So my portfolio here. So what I'm going to be adding, and I wanted to do this so I can get paid larger sums on a weekly basis. So between all of these here, I'm adding in GUI, FBY or NVDY. I haven't decided which one yet. BITO and AMZY. So 3 of those are yield max, and then BITO is just a Bitcoin one. So this way I'm going to be getting paid weekly ones from 3 different places. And I got massive jumps this week. Coney is paying me out $2 a share. Huge jump from YMAX, huge jump from QQQY and WDTE. So again, obviously with the rally that we saw last week, we saw big jumps. And with crypto running, Coney's been doing well. But I want to be able to play where I'm going to be getting not only these weekly ones, but every single week I will get paid out one of the monthly ones. That will bring in significantly higher cash flow on a weekly basis to be able to put down here. I am not dripping any of these. This is strictly short term. When I say short term, it could be 2 years. It could be shorter. If I see that these are all starting to collapse, if the entire stock market collapses and these are not coming through and paying out the yields that I want, then I will dump them. I have no problems doing that. These are ones that are on very, very tight leashes that I'll be paying attention to. And again, it is strictly for income to take advantage of opportunities to be able to build up in all of these other plays. Now, these down here, I'm going to be adding XDTE and HBYI as well. So I'm going to add those 2 in. Slowly, I'll be adding over time and building this one up. And these are the more stable plays. I don't plan on selling any of these here. These are the ones that are kind of going to be my staples going through a recession, because they will be paying the higher dividends. Now, I'm also going to be paying attention to some of the BDCs, because in a recession, those could get harmed. And some of those have historically cut dividends. So again, those will be on tighter leashes, but the rest of these covered call ETFs, I will be riding those and using that income to buy the dividend growth plays at a massive discount. And that's what the tentative play for this is. And even if we don't get into a recession, this play that I'm doing still benefits me and plays out well, because then I don't have to sell any of my ultra yield income. I don't have to sell any of my BDCs. That's just higher cash flow coming in to continue growing my portfolio. So I kind of set it up as a win-win situation. I just have to pay attention to what is going on with the market to make sure that my ultra yields aren't going to be getting high NAV erosion and, getting collapsing entirely and actually losing me money. Down here, I have PLD. I have a stop loss on 2 shares here. So it was close today, but I still have a little room to go on that. So we'll see if if that sells off, it'll free up about $200 for me. And I was looking at AbbVie. I'm keeping my eye on. I'm not a huge fan of pharmaceuticals. AbbVie has been a good one, but they just had a drug that they were waiting on for schizophrenia that did not pass phase 2 of their trials. So because of that, it sold off significantly. And when it comes to pharmaceuticals, you want a pipeline that's strong. And not to say that they don't have a strong pipeline, but that was one of the big ones in there. And Bristol Myers Squibb just had theirs get passed in September. So because theirs went through and AbbVie's didn't, that's competition that they will not have, and they're going to be losing out. So just keeping my eye on that one. I have no problem selling that out. I've got United Healthcare as my play when it comes to a healthcare plays, the plays that are out there, and that's not going anywhere anytime soon. So we'll see if I free that money up. And again, when I have SCHD has a significant amount of AbbVie in it, so it's not like I would be losing out entirely if I sold it off. And then, of course, I've got my cryptocurrency, which has been skyrocketing. And again, when I take that money out of the Doge, I take $50 out, and it doesn't drop my coins down all that much, so I'm not too concerned about it. So overall, I'm getting close. I'm almost to that 10.25, 10.25% cash that I wanted, so that I can start adding back into all these plays, because I'm waiting for that 10.25% cash to be able to add to these plays here. And I should be able to get it tomorrow, because I'm getting about $100 from Coney, and I'm getting about $20 total from these 3 here. And so with that, I should be at about that 10.25%. And then any extra cash after that, I will be able to start adding to this. Oh, I'm getting paid out on realty income tomorrow as well. I think that's $7 tomorrow. So that's kind of what I've been doing in my portfolio recently. And it's been working out well for me. I mean, I can't complain. Obviously, the market's been going up, so everybody's happy about that. But I'm still kind of putting myself in the fighting the FOMO. Of course, I'm thinking, oh man, if I had taken, the $25,000 I put into this house and I ended up just buying all Dogecoin, well, how much money could I have had? And I was like, but taking gambles like that is just not my style. I'm a lot more conservative. And so having, a few percent of my portfolio in that to make a little extra money, take that $50 out here and there to speed up that process, I'm cool with that. I'm totally fine with that. And I feel much safer, and I can sleep better at night with that. Misty, Coney, QQQY. So Misty is one I thought about getting into. It's like an extreme version of Coney, and because I have Coney right now and I'm going to buy BITO, I'm not going to bother with Misty. That one's been paying out insane dividends. But I'm gonna hold off on it. That is not one at this point. It's one of those things where it's so high right now. It's kind of like buying at the top, and I'm kind of leery of that. So I'm gonna hold off on that. QQQY, I'm good on. And QQQY and WDTE, those two play at puts instead of covered calls. So it's a little bit different. So obviously last week they still did very well. But with the market going up, they don't do as well, just because if it's trading sideways or slightly down, they do a little bit better. But in the market that we've been having with it running up, hasn't been as good. So I've been watching the NAV erosion on those. They've already done a reverse split. But I bought them after the reverse split. Or did I? No, I bought them right before they did it. So I'm keeping my eye on it. Maybe I sell them, maybe I don't. Again, they bumped up this week. So again, paying out weekly gives me a lot of time to just pay attention to what they're doing and make a decision that is best for me. Yeah, slow and steady wins the race. Haven't anyone that can change the past. Exactly. I can think about, if I had done this, if I had done that, if we all knew that COVID was coming, we would have all been stockpiling our cash, sold all of our positions out in January of that year, right at the top. And we would have waited until April and bought at the bottom of the market, and we'd all be multimillionaires right now. But we can't do that. It's impossible. All we can do is take the information that we have at hand right now and make the best decision that we can. And you look at historical data, and historically, dollar cost averaging is the best way to garner long-term wealth. And for me, I created my portfolio the way I did to do a modified dollar cost averaging to try and kind of do a longer term swing trading type of style where I can trim the top off of some of the positions to put them into the other ones to kind of speed up that process for the dollar cost averaging and to get myself more income. So that's all I've done for myself, just my own version of it. And there's one other play I might be getting rid of as well. VYM. I have VYM and DGRO. They both basically cover the exact same thing. They're almost exactly the same fund. So looking at them here, I'm trying to decide. I want to decide if I want to get rid of one of them, if I don't. So here they are here right next to each other. I mean, they're both basically the exact same. The dividends payout almost exactly the same. Yield is almost exactly the same. They have almost exactly the same stocks in their funds. DGRO has like 100 less than VYM. So for me, looking at these two, I'm going to look at also the expense ratio, and I want to look at their dividend growth history. So once I look at those two things, I'll determine which one I'm going to get rid of. And when I do that, it's going to free up $1,250. Now, I've contemplated jumping into SCHG to get a growth play. The problem there is VU, just the S&P 500 is basically the same, but the VU also has a lot of other plays that aren't just strictly tech. But I still, because it's so heavily weighted on the top with the tech, do I bother with an SCHG? I'm going to wait on that. The reason I'm going to wait is because I don't need it. My IRA, I have QQQM, which is basically the same thing as SCHG. And when I'm looking at a potential recession for next year, if I was going to buy SCHG and we do get the recession, I'll just wait till that hits. And I have no need to buy into that. I've got plenty of tech in many other places in my portfolio. So, like I individually own NVIDIA, Meta, Apple, Microsoft, Broadcom. So I've got all of them in my portfolio individually, Amazon, Tesla, SoFi, Palantir. So I don't need to have the ETF. It's just a nice kind of piece of the portfolio to kind of, fill in that bit of a gap. But again, I will take a look at that next year or as I go. But if I end up if I do end up selling one of them off, that frees up that $1,250 that I can distribute to some of the higher funds that I want to get into. That'll give me that more income. And this way I can get the higher income coming in, which gives me a lot more versatility. And I like the versatility. I love having cash flow coming in because having that cash flow allows me to be able to maneuver one way or another a lot easier. And that's really what I wanted to have, is the ability to be agile in my investing. Warren Buffett's accumulation of $300 billion for buying something at lowest point, maybe. So Buffett, he has that much cash for a few reasons. One, he was building it up because he didn't know who was going to win the election. And if Harris won the election, there was a good chance that corporate taxes were going to go up significantly. And he wanted to make sure that he had money on the side for that. Insurance rates have also been going up significantly. And because he owns Geico, and because they, I think it's Geico that he owns, and because they have a lot of other companies that they own as well, insurance rates going up, he needs to have a larger cushion to be able to take care of any issues that could possibly come up. Then he's also said that because the market being as frothy as it is, like there really hasn't been much out there for him to buy. He's been buying into Oxy, but he's been selling out of Apple. He's been selling out of Bank of America. And as my dad says here, he just bought Pool. So, Warren Buffett saying that there aren't many deals out there and then buying Pool means that that's probably a good deal. Obviously, following Warren Buffett's portfolio isn't something anybody should do, but clearly he's been successful with it. So, take it as your own. Now, granted, looking at Occidental, that is actually below his cost basis on it. His cost basis is around $54, and right now it's under 50, or it was under 50. So, he does play the long term. So it's not like he's looking at 2 years and going, oh, darn, I missed out on that one. He's playing the long term play. So, when we look at Occidental 5 years from now, we'll have another discussion about it and see where it's at. But that's when he's looking at anything to buy and he actually buys something, tells me that there's probably a good deal on it. And it's crazy because with that kind of money, he can literally buy pretty much any company he wants. I mean, other than like the top 10 companies that are out there, he can just go ahead and buy an entire one of the giant companies because he is in the top 10 with Berkshire. Thanks, Lang. Yeah, it is Geico. That's what I thought. So yeah, so I mean, and again, I've based a little bit of my strategy on Warren Buffett. Obviously, a guy doing very well. Dividends are a big piece of his portfolio, and I don't know how to value companies like he does. I've been researching as much as I can about all of that, but just looking at what people are successful with a limited time that I have to look into things. I was like, well, other people see that these are successful. These have been historically good. The Procters and Gambles, the Johnson and Johnsons, companies like that. It's not too bad to go into those and say, hey, these obviously have been good. They're most likely not going away anytime soon. They're consumer staples. They're not going to give you that flashy growth like the Nvidias of the world are going to do, but they're going to give you that steady pace. And when we get into rougher times, they're going to be there as a solid foundation for you. Oh yeah, I forgot about Chubb. Yes, for Buffett, 6 months is a long term. Yeah, he is also big into Chubb. Yeah, Chubb's another one. Yeah, and that's the whole investing strategies. Buy and hold forever. If you're going to hold forever, that's it. And you obviously constantly want to do the reassessments on your companies that you own, because you never know when one is going to go south, something goes bad. Like looking at AbbVie, I buy the company with the intention to hold it forever, but then if I get some news or something that tells me, hey, you know what, the fundamentals could be shaky, the pipeline might not be as strong as we thought it was, the drug that we thought was going to get approved is not going to get approved. So you're like, hey, do I take profits on that and sell out? Or is this an opportunity to buy at a discount and then push it forward? I've been adding more to it. So as it's been dipping, I did add more to it, but I'm still keeping my eye on that. So it's one of the things I go through is I see, hey, when you're buying a stock and it's got a dividend and the stock price comes down, that means the yield is going to go up. Cool, but if you buy strictly based upon yield, that could be a yield trap. And a yield trap is a stock that the yield is going up, but the yield is going up because the company cash flow and the company valuation continues to drop. So you're actually losing money over time and you're chasing that yield, hoping to make up for that company losing value, and then hoping that at some point that company actually turns things around. And I don't like to base any of my strategies on hope. Hope is not a strategy. So if you're hoping that a company is going to turn around, terrible idea. So a lot of people were looking at Tesla when it was selling off. A lot of people were hoping it was going to turn around. And I'm like, I thought it was going to turn around, but I was basing that on a lot of other information. If you're looking at it from a fundamental standpoint, or learning the reasons why the stock is selling off, and that's kind of the reason why I did what I was doing for you guys when Elon was selling, was explaining this is the reason why the stock is selling off, just like I did with the gaps the other day. This is what I see. This is the reason why I see this is going to potentially happen. And this is what I think is going to be the positive and negative for the company. When you're looking at it from that standpoint and you say, oh, okay, I understand why the valuation is where it's at. I understand what could potentially happen because maybe it's a little overvalued. We're probably going to sell off in the near term based upon technical analysis, based upon why it ran up on a sentimental basis. You see things like that and they say, well, where are the fundamentals at? It's a little bit lower than that. Then you start looking long term, what's your investment thesis? There's so many other pieces that go into it. But when you're looking at all of those pieces together, and then you've come up to that conclusion of, all right, well, looking at now, they may get rid of the EV tax credit. How is the EV tax credit going to affect Tesla? It's going to affect Tesla negatively in the near term. In the long term, it may do well because the little bit of competition that was out there, which really wasn't anything, they were all clinging on to those EV tax credits. That's going to be destroyed. Most of them are already shifting over to hybrids anyway right now, and they've pulled a lot of funding out of their EVs. VW partnering up with Rivian is basically going to be their saving grace, and that's VW saying, we're struggling. Germany is going through a very rough time in their economy right now. So because of all of that going on, you've got you know, Tesla potentially in the long term could benefit very much from this, but you don't know. But you look at factors like that saying, well, it may sell off in the next year just because their margins will come down because they don't have those EV tax credits. Elon has said they don't need them. Who cares? Elon is totally cool with going to 0% margins. And if they're going to be putting out the new production, the whole production process next year when it comes to cutting all the costs, and they can actually cut the cost of maybe a Model 3 hatchback next year, the cost of it to $27,000. That means they're going to be dropping the cost of all their vehicles, thereby giving them a little more padding in their margin. So that gives them the pricing power, and they don't need the EV tax credits. That means that they're the only kid on the block. That means they're the only play that's out there for EVs, which could be very beneficial for Tesla. So again, you've got to factor all of these things in and then make your own decision as to what you want to do based upon that information. But if you are not looking into all of those details before you are making a decision, then you're not doing yourself any good. You've got to be able to make sure you're doing that research to understand what is going on with your companies before you're going to be buying it. Because if the company is going down and you're just buying because you hope it goes back up, that is a terrible reason to buy. And if it does go back up, you got lucky. Are you seeing the gap at 270 fill? Yeah. Looking at the way it's moving right now, seeing as we closed under the 314 to 316 level, that was a level of support, which was a hard level of resistance before. I'm interested to see where we're going to close tomorrow. If we close below that level again tomorrow, I'm going to start paying attention to 295 to 300 level because that's going to be the next level. It was the psychological support before. So I think we would dip down to that. And then if we drop below that, we could fall all the way down to fill that 270 gap and then potentially go below that to fill that 218 gap. And that's, again, a massive fall, but it was basically falling as fast as it went up. So no, that's just, those are the levels I'm looking at for the near term stuff. Stocks market, I dipped my toes into Tesla call options for the first time a few days ago, and well, look at us go down. So you're saying we could blame it all on you. As always, don't bet more than you're willing to lose. Exactly. If you're going to be doing options obviously are an exaggerated version of it, and margin, man, just please, if you're going to go on margin, everybody has their own risk tolerances. You guys make your own decisions. You're grown adults, but be careful with margin because you do something like that on margin, you can lose more than you've got. So, at least playing options, you go in there and, you lose what you put in. You go out there and you use margin, you can lose more than you put in. You can lose more than you even have. And that's extremely dangerous. What do you know of BN and BAM? I actually don't even know which two of those are. Without EV credits, ICE and hybrids are in big trouble. Yeah, less EVs and other companies will afford to make EVs. I don't know BN and BAM. Let me do a quick, as long as my computer is not gonna. Okay, let me see. What is this? Get out of here. Brookfield Corporation. Not familiar with Brookfield, but they looking solid. They got a solid looking chart here. Hold on, let me bring it up for you guys. Let me see. Get out of here. Let's see. All right, so here's BN. That's Brookfield Corporation. So looking at Brookfield Corporation, $58. And again, I don't know enough about the company to say anything yay or nay. I could just strictly look at the charts, which actually somebody had asked about doing a gap analysis on NVIDIA. I thought about it. Gaps are super easy for me to read. So if you guys want, I will absolutely do gap analysis. I'll do a weekly video on a different gap, different companies. And if it's quick, I can do multiple companies in one video. And if you guys want that, just let me know in the comments or whatever, what companies you want me to go over gaps on. And I will absolutely go over those. So yeah, looking at the chart on the day looks solid. Let's see what we got. 5-day. Oh, see, I had that massive jump here. Yeah, this thing is gapping all over the place. What is going on? 1 month. Yeah, see, that's got gaps. So if I do the day chart here, Yeah, this has some gaps. This goes back to, well, it's November of last year, but again, Tesla filled gaps that were 2 years old. Yeah, I'd have to do some more research on this company itself just to see what it is that they are doing, to determine what's going on. And then BAM was the other one. So another Brookfield. Yeah, I'd have to do a little more research on that line just to see what those are all about. I swear there was a Brookfield that I was in. I don't know if it was a mining company that I looked at one point, and I don't know if they're related at all to each other. Um, but yeah, I'll do. Yeah, I'd have to know more about the company itself to determine. But just based on the charts, I mean, they look like they're relatively solid. But you have to look into that one. Let's see. Yeah, yeah, I will absolutely do gap analysis. I really enjoy doing that. And again, it's for me. I mean, I'm again mostly a long-term investor now. I've kind of slid away from those gaps, but I'm good at it. So I theoretically could play them. But again, despite the fact that I can see them and I know what's going on, I still don't know if they're actually going to trigger. And then the timing of it is the hard part. So I can say, hey, Tesla has a gap down to 218, but maybe it takes us a year and a half to get there. A lot can happen in a year and a half. And in that year and a half, just like what I saw for Tesla in the last 2 years, I made a lot more money than I would have with Tesla. Because with Tesla, I would have actually lost money versus where I'm at now, where I made thousands of dollars. So it's a significant difference there. And again, that's why I don't play the gaps, but I will absolutely tell you guys all about them and do the gap analysis so you guys can make your own decisions based upon that information. But again, when it comes to gap analysis, I don't know timing of when they're going to fill or if they're ever going to fill, but at least I can give you guys that information. All right. I'm probably going to call it quits here in a minute. I got to get up early in the morning to go to work. It's Friday, finally. Friday, got there. It's a good time. But yeah, I mean, so far the market's been cooling off. So now I think we're at the point where the market got through the excitement of the election and we're cooling off. And now we kind of need to settle down and find a base. And we'll see where that base ends up landing, whether we're at it now. It seems like cryptocurrency is kind of settling where it's at. Tesla cooling off today. So that's just kind of what I'm paying attention to. And we'll discuss it next week as the next week plays on where the market's going to move from here. Are we going to get that Santa Claus rally where we typically see the market run into the end of the year? Or are we going to get the opposite, seeing as we never got a real sell-off going into the election? So, yeah, that's all I've got for you guys tonight. Love you guys. Hanging out with you guys is awesome. And I will check you guys out next week. And again, I will just let me know in the comments below if you guys want to see any gaps. Just let me know what tickers you want, and I will put those on the list and start adding to them for next week. So thank you guys for all being here. Appreciate it. We'll see you next time.